Hi there. Welcome to the Finance for Teachers blog. My name is Dave Grant. I am the founder and a financial planner with Finance for Teachers. And this week's video is all about the economy. Now, the reason we're talking about the economy is I get a lot of questions about it from people I work with as clients and questions that come through my website. People ask all different questions about the economy and what they should be paying attention to. So I'm bringing a guest on the blog today. You'll meet her in a second. Her name's Catherine, and she is kind of an expert on the economy. She's worked in the hedge fund industry. She's studied the economy for decades, and she is someone that I feel very confident in bringing to you and is going to be able to explain some complex situations in the economy and make them very simple. Beyond what I can do, she's got the expertise. So sit back, look at the interview, and enjoy. All right, Finance for Teachers readers, thank you for coming back to the blog. This is another video blog, as you can tell, and we're going to be talking about the economy today. And you'll notice it's not just me. I have a lovely, attractive woman, so you've got two attractive people on the video to watch. But there's a reason there's two of us. So joining me is Catherine Ciccoletti. She is the founder of the MSB Cheat Sheet. And I don't want to take away your thunder. So, Catherine, why don't you tell us who you are and why you're here?
Well, first of all, thank you for saying my last name correct. No one ever says that, right? um, so why I'm here? I don't know. You invited me on here. No, I, I'm here because, well, I actually think that you invited me on because we sounds like we have a similar philosophy. Um, and I worked in finance for over 10 years and just happen to believe that a lot of this content out there for investing, getting your money invested in low cost funds, growing your money is just way overcomplicated and too confusing. And it's really not that difficult and can actually be more fun than the financial community presents itself to be. So I, uh, I have a membership based monthly newsletter that's basically directed to non Wall Street people, and that it helps people that don't know where to get started investing. Picking investment funds is really the focus of it. How to create your own portfolio. So a lot of stuff that you talk about.
But you were talking about the economy a lot and regular day things that were happening on the news. Um, and I get questions that I field from clients and readers, and they want to know, what types of things in the economy should I be paying attention to? A lot of it's bad news. Should I be acting on anything that I hear? What's your take?
The sad truth is, I think you need to pay attention to very little. I mean, uh, the Fed comes out with minutes from their meetings. They make a statement. They say the same thing. They've been saying the same thing for how many years now? The problem is it is hard. At some point, they will say something interesting, and it will actually be impactful. So it's hard to decipher the average person, for them to decipher what do you pay attention to and what do you ignore. And I would say,
Hmm.
unfortunately, you can probably ignore 90% of what you see, and your money will be growing just fine. You don't need to be making tweaks based on oil. If oil's down 7% one day, it's up 7%, you know?
Exactly.
I mean, if you're investing in a oil specific fund or stocks, then that's a different story,
Hmm.
But none of the people that I'm, you know, working with, no, you know.
So, I mean, you mentioned oil, and if you're trying to play the oil game, that's probably something you should be looking at pretty closely. But are there any economic things that you should be really looking at if you're investing for the long term?
I focus on, I mean, and these are things that we talk about in the cheat sheet every month. I mean,
Yeah.
not to get too, you know, uh, economic-y, but, paying attention to the interest rate that a 10-year government bond pays you. We all know that if they go up, the value of your bonds are going to go down. They're at historical lows right now, so there's a higher chance they're going to go up than down over the long term. So people, but not every day. I mean, gosh, once a month. You know what I mean? Just look at it once a month. You know that I would say inflation again, not every day, once a month, because inflation right now is really driving what the Fed is doing to interest rates, which then impact the bonds.
Sure.
I would say those two things, and then obviously, I mean, unemployment rate to a less extent because we're getting down to a historical level again, and the Fed actually has kind of thrown that out, even I think a little bit as a leading indicator for them. But the last thing I focus on, again, I don't look at this every day. I mean, this is a monthly thing. Watching trends is PE ratios. You know, the price that stocks are trading at relative to the underlying earnings they're generating. If the price they're trading at on the stock market is really, really high relative to the underlying money the business is making, you know, then we know stocks can get overvalued or overheated. And if you look back at last bubbles, you know, these numbers were really high. So this is something everyone's paying attention to right now. Again, but also, do we need to debate this every day? No. You know, we know they're above average levels. Everybody knows that. You know, just watch it, you know?
Yeah. And I think it is interesting because I think, you know, being in the industry that we're in, we're more inclined to look at it closely and maybe look at it more than we should.
Right.
And then when we talk to people that we work with, you know, a lot of the terms that we may be discussing now with PE ratios, that may just be they're like, I don't know what that is. But it gets to the point of, you know, is this something that's going to be a blip on the radar? Right. Or is this something that I should be concerned about looking long term? So, you know, when you talk about oil, you know, it's gone up to historic highs and now it's going back down again to the lows again.
Yeah.
In your opinion, is there anything happening in our economy today that could be seen as a long-term play for how to invest, or are there, you know, things that are happening which are just going to be blips and we'll forget about it in 5 years? Nice long question for you, which has got two questions inside of it.
Yeah. I mean, I'm personally overweight international stock markets at this point. So when you're talking long term, I mean, yeah, Europe is going through, you know, is much later than the U.S. in terms of the recovery coming out of the financial crisis. So in terms of the long term, could they have a bad year this year? Yeah, but if we look at how expensive they are relative to the U.S., it's much cheaper. I'm a long-term investor only because I'm lazy. I don't want to be trading around funds every day, every week, every month. I don't want to be, you know. But if you just
time out right there,
yeah,
just for Finance for Teachers people, that's my investment philosophy. I flip what every asset manager in the U.S. does, which is going heavy into U.S. markets. I flip it and go heavy into international markets. Just that's where I've come from. I know that there's so much more out there than the U.S. and there's. Yeah. And I love the fact that you agree with that too.
Yeah.
So carry on.
Well, no, I mean, and I think that if you just focus on one geographic region, meaning just the U.S., you're limiting yourself in terms of some upside and then diversification. You know, I mean, last year's a perfect example. The U.S. stock market was up 13%. You know, and European stock market was down, you know, so you need to have exposure to different regions. And it's like the whole saying, you know, buy low, sell high. I mean, that's what we're talking about here.
Yeah.
You know, Europe is low, you know, it's like if you're going to buy a house, you buy a cheaper house, right? You buy the cheapest house on the nicest block, right? Like that's what you want to do. So not following, you know, oh, the U.S. stock market was up 13% last year, so it's got to do the same thing this year. Let's, you know, that's So I don't have any sexy answers for you, unfortunately. I would say I'm bullish on long-term international markets. more than US. And
Hmm.
it could take a couple years to get it going, but that's just how I'm positioned right now. And all funds, of course, no individual
Yeah.
stocks for me.
No, we love boring around here. So
Yeah.
you fit right in.
Seriously, it's like, don't you have better things to do than obsess over your
Exactly. All right. I actually sent out a request to readers of the blog before I was doing this interview and kind of gave people a heads up as to what we're going to be doing and discussing. And I had some reader questions. So I wanted
Okay.
to post two of them to you.
Okay.
So, first one, most of my retirement income will be coming from a pension. Should I be investing any differently from someone who doesn't have a pension?
Um, well, I would say your objective with your pension money is capital preservation,
Hmm.
is to not lose it, right? Meaning you don't you don't need to be swinging for the fences with your investments, I would say, if you have a pension. If I had a pension, I would be trying to earn, a modest rate of return every year, maybe from income payments, interest payments, but someone without a pension that is more reliant on growing their money,
Hmm.
I would say would have a different investment strategy uh, because you know they don't they don't have a steady stream of pension money coming in. Relying
Sure.
on Social Security. I don't know where the reader's question is, but I'm assuming the U.S.
Yes.
So I would say having a pension gives you the ability to be a little less aggressive.
Yeah. I've had, and that's not the only time I've fielded that question from the teacher crowd, and they either fall in two camps. One, it's, I've got this guaranteed money. I don't need to be as aggressive with my investments. I
Yep.
can kind of take it easy. And then you've got these interesting people on the other side that say, I've got this guaranteed money. Let's go for the home run with our investments. Let's just go for it.
No. Oh my God.
And I'm like, if you want to strap yourself in and go for that ride, I'd be happy to guide you on it, but you don't need to do that.
I think that for people like that, that's like a personality thing, and that's not
Mm,
that's not bad. I would just say, uh, you know, siphon off a little bit of that money and have that be your. They work with you to maybe put it in some aggressive, I don't know, emerging market funds or something.
yeah,
But the whole boat. But some people like to just take risk, and you can't. You know what I mean? You can't talk them out of it. So
yeah,
getting them to invest in a fund, a higher risk, higher return fund would be safer than having them go out and trying to pick individual stocks on their own.
sure.
You know,
So if you're going to be aggressive, be smart about it.
if you're gonna be aggressive, at least be conservative aggressive.
Yeah. All right. The other question, and this one's on the other end of the spectrum. I'm a young teacher and just started reading the Finance for Teachers blogs. I know I should be taking some risk with my investments, but I'm a little nervous. I have a whole career ahead of me, so I know I can ride out most bumps, but I'm not sure what to do. What would you suggest?
Well, I would say that this this is so boring, but I would say pick 4 low cost investment funds, 3 or 4, spread them out, spread your money out across those 3 or 4 funds based on how aggressive or non-aggressive those funds are,
Hmm.
and set your amount that you want to have invested in each fund. Revisit that amount every quarter to make sure if some have lost money and some have made a lot of money, back to the buy low, sell high thing, you're going to want to rejigger it.
Yeah.
But pick a handful. I don't know how old this person is, but low cost stock funds. I'm assuming they're on the younger side in their 30s.
Yeah.
They could do a short term bond fund if they felt the need.
Yeah.
But I that's the whole thing. Is it's really, I think, pulling the trigger is the hardest part on this stuff.
It is, and it's the emotions in it too.
Yeah.
It's yes, there's nerves, but are those nerves going to be there in 30 years when you need that money? It's probably going to be a different type of nerves, and you may be kicking yourself for not doing something earlier, which is typically the case recently. People
Yeah.
are just looking back and saying, "I wish
Oh,
I'd have done something sooner."
oh my God. I mean, people that pull their money out after 2008,
Hmm.
that's a perfect example of
Yeah,
missing a lot of money.
yeah. Now, I think on this, the last thing I would say for a young teacher is do the sleep test. If you have investments that wake you up at night, you're obviously too aggressive. It's going to be worrying you.
Oh, I like
So
that.
and so dial it down a little bit until you can sleep. And once you see the big ups and the big downs and it doesn't worry you, that's probably okay. Just stick with that.
Yeah.
So, well, that's good. This has given, I think, readers a lot of different flavor than they're used to on the blog, and I appreciate you coming along. It's been very helpful. Um, Watching the video, if you want to get in touch with Catherine, all of her contact details, her website, Twitter, Instagram, everything, in the YouTube video, it's down here in the show links. In the blog post, it's either going to be up there or down there, depending on how it gets written. Um, and yeah, if you feel like trying to find it a kind of sexy way, go that way.
Yeah.
And but do check out Catherine. She has a lot of fun videos. It is the MSB cheat sheet, and you can get a lot of good insight from her as well as me. So don't just rely on me.
Yes.
Yeah.
Love what you're doing. Yes.
Thank you.
Go teachers.
Yes. All right. Thanks, Catherine.
Okay, we'll talk soon. Thanks.
Bye.
Bye.